In the final days of December 2025, something extraordinary happened in the financial markets that sent shockwaves through Wall Street and beyond. Silver, a precious metal that has been traded for millennia, suddenly became the epicenter of one of the most dramatic financial events in modern history. The price of this shimmering metal exploded past $77 per ounce, shattering all-time records, and leaving financial analysts scrambling to explain what was unfolding before their eyes. But this wasn't just another commodity rally driven by simple supply and demand dynamics. This was something far more profound, far more dangerous. And it involved $17 billion of emergency funding that banks desperately borrowed from the Federal Reserve to stay afloat. What you're about to discover is a story of leverage, manipulation, desperation, and a market squeeze that could reshape the entire global financial system. The numbers tell a story that's almost impossible to believe. Silver entered the year 2025 trading around $30 per ounce, a price that many investors considered reasonable given historical patterns and industrial demand. But by late December, that same ounce of silver was worth more than $77, representing a mind-boggling surge of over 150% in a single year. This wasn't a gradual climb or a steady bull market. This was a parabolic explosion that defied conventional market wisdom and caught even the most seasoned traders completely off guard. To put this in perspective, silver's year-to-date performance in 2025 exceeded that of almost every major asset class, outpacing even Bitcoin's legendary rallies and leaving gold's impressive gains in the dust. But what made this surge truly unprecedented wasn't just the magnitude of the price increase. It was the speed, the volatility, and most importantly, the underlying mechanism that was driving it. A massive short squeeze that had major financial institutions trapped with nowhere to run. To understand why banks are suddenly facing an existential crisis that required $17 billion in emergency Fed funding, we need to understand what short positions are and why they're so dangerous in volatile markets. When traders or institutions take a short position in silver, they're essentially betting that the price will fall. They borrow silver or silver contracts, sell them at current market prices, and plan to buy them back later at lower prices, pocketing the difference as profit. It's a strategy that works beautifully when prices decline, but becomes catastrophically expensive when prices rise instead. Every dollar that silver's price increases represents a direct loss for those holding short positions. And in leveraged futures markets, those losses can multiply exponentially. This is exactly what happened in 2025, and the institutions caught on the wrong side of this trade found themselves in a nightmare scenario that threatened their very survival. For decades, there have been persistent rumors and allegations that major banks have been manipulating the silver market by maintaining massive short positions in paper silver contracts. These weren't small speculative bets by individual traders. These were enormous positions worth billions of dollars, held by some of the world's largest financial institutions. The strategy seemed foolproof for years. By maintaining heavy short positions in the futures markets, these banks could effectively suppress silver's price, keeping it artificially low while they accumulated physical silver at bargain prices. It was a sophisticated game that required deep pockets, significant market influence, and the assumption that retail investors and smaller players would never organize effectively enough to challenge the established order. But 2025 proved that assumption catastrophically wrong, and the banks that had grown comfortable with their market dominance suddenly found themselves facing an opponent they had severely underestimated. Millions of retail investors armed with social media, shared information, and a burning desire to expose what they believed was systematic manipulation. The most shocking revelation in this entire saga came when reports emerged that major banks had borrowed approximately $17 billion in emergency funding from the Federal Reserve. This wasn't routine liquidity management or standard central bank operations. This was panic borrowing, the kind that happens when financial institutions face immediate existential threats to their balance sheets. The Federal Reserve's emergency lending facilities exist precisely for moments like this, when the stability of the financial system itself hangs in the balance. But what made this particular borrowing event so significant was its timing and its obvious connection to the silver market chaos that was simultaneously unfolding. These banks weren't borrowing $17 billion to fund new investments or expand their operations. They were borrowing it to meet margin calls on their silver short positions, to prevent forced liquidations that would have sent silver prices even higher, and to avoid a cascading crisis that could have spread throughout the derivatives markets. When you hold massive leveraged short positions and the underlying asset's price suddenly doubles, the mathematics become brutal very quickly. The margin requirements, the collateral you must maintain to keep those positions open, increase proportionally with the price movement. If you cannot meet those margin calls, your broker or clearinghouse has no choice but to liquidate your positions, buying back the silver contracts at whatever price the market demands. In a rapidly rising market, this forced buying creates even more upward price pressure, which triggers more margin calls, which forces more buying, creating a death spiral that can destroy even the largest financial institutions. The Federal Reserve's $17 billion intervention was essentially a lifeline thrown to banks that were drowning in their own leverage. It provided the immediate liquidity needed to meet margin requirements, preventing forced liquidations that could have pushed silver prices even higher and potentially triggered a broader financial crisis. But this intervention also revealed just how serious the situation had become. The Fed doesn't hand out $17 billion lightly. This was emergency medicine for a market that was genuinely sick, and it exposed vulnerabilities in the financial system that many hadn't fully appreciated until that moment. One of the most fascinating chapters in this silver saga involves JPMorgan Chase, one of the world's largest and most influential banks. For years, JPMorgan had been at the center of silver market manipulation allegations, with whistleblowers and market observers claiming the bank maintained enormous short positions in paper silver while simultaneously accumulating massive quantities of physical silver in its vaults. The strategy, if true, was brilliantly cynical: suppress the paper price through short selling while buying up physical silver at artificially depressed prices. But something remarkable happened in 2025 that completely changed this narrative and perhaps provided the clearest signal that the silver market was entering entirely new territory. According to multiple reports and market analysis, JPMorgan made a historic reversal of its position during 2025. The bank reportedly sold or covered its massive short position, which had at one point represented approximately 200 million ounces of silver in paper contracts. More incredibly, JPMorgan didn't just exit its short position, it flipped entirely to a net long position, reportedly holding approximately 750 million ounces worth of long exposure. This represents one of the most dramatic position reversals in commodity trading history, and it sent a clear message to anyone paying attention. The banks that had been betting against silver were now betting on it, and betting big. When the biggest player in the game changes sides, smart investors take notice. And in 2026, that's exactly what happened. JPMorgan's reversal wasn't just a strategic shift. It was a white flag, an acknowledgement that the old game was over, and that attempting to maintain short positions in silver had become untenable. The bank that had allegedly profited for years from suppressing silver prices had apparently concluded that the physical supply constraints, industrial demand dynamics, and retail investment momentum had created a fundamentally different market environment. By flipping to a long position, JPMorgan positioned itself to profit from the very price surge it had previously tried to prevent. It was a masterclass in strategic adaptability, but it also left other institutions that were slower to recognize the changing landscape exposed to catastrophic losses when the silver squeeze intensified in late 2025. What made 2025's silver surge so powerful wasn't just one factor, but rather the convergence of multiple powerful forces that created a perfect storm in the precious metals market. First and foremost was the supply deficit that had been building for years. According to the Silver Institute, the global silver market was heading toward its fifth consecutive year of structural supply deficit in 2025, with demand exceeding production by significant margins. This wasn't a temporary imbalance caused by a single year's supply disruption. This was a persistent structural problem driven by declining mine production, particularly in Central and South America, where many major silver mines were being depleted or facing infrastructure challenges that made extraction increasingly difficult and expensive. On the demand side, industrial applications for silver were exploding in ways that previous generations never could have anticipated. The global push toward renewable energy, particularly solar power, created enormous demand for silver, which is an essential component in photovoltaic cells. Reports indicated that solar demand alone was consuming approximately 98 million ounces of silver annually, and that number was projected to grow as countries worldwide accelerated their renewable energy transitions. Add to this the growing demand from electric vehicle manufacturing, where silver's superior electrical conductivity makes it invaluable, and the semiconductor industry, which relies on silver for various applications, and you have a recipe for sustained industrial demand that shows no signs of slowing down. But industrial demand was only part of the equation. Investment demand also surged dramatically in 2025, driven by growing concerns about currency debasement, geopolitical instability, and inflation fears. Silver-backed exchange-traded funds recorded massive inflows, with some funds delivering returns exceeding 130% during the year. Retail investors, many of them organized through social media platforms and online communities dedicated to precious metals investment, began purchasing physical silver in quantities that stressed the supply chain. Coin dealers reported delays in premiums on physical silver products as mints struggled to meet demand. This wasn't just financial speculation happening in abstract futures markets. Real people were buying real silver. removing it from available supply and exacerbating the physical shortage that made the bank's short positions increasingly untenable. At the heart of this crisis lies a fundamental tension that has existed in precious metals markets for decades. The disconnect between paper silver traded in futures and derivatives markets and actual physical silver that exists in finite, tangible quantities. The silver futures market operates with substantial leverage, meaning traders can control large positions with relatively small amounts of capital. This leverage amplifies both gains and losses, and when prices move violently as they did in 2025, it creates the potential for rapid wealth creation or complete financial destruction, depending on which side of the trade you are on. The problem with paper silver markets is that they created a situation where far more silver is claimed in contracts than actually exists in physical form available for delivery. Under normal circumstances, this isn't problematic because most futures contracts are settled in cash rather than physical delivery. Traders take profits or losses in dollars, and the physical metal never changes hands. But when holders of futures contracts begin demanding physical delivery, as increasing numbers did in 2025, the entire system comes under stress. The COMEX, which is the primary exchange for silver futures trading, maintains inventories of physical silver to facilitate delivery. But those inventories are limited and can be depleted rapidly if demand for physical delivery surges. This created a cascading problem for institutions holding short positions. Not only were they facing massive mark-to-market losses as silver prices soared, but they were also facing the prospect of having to deliver physical silver they did not but possess to fulfill their contractual obligations. In a normal market environment, they could simply buy silver in the spot market to cover their delivery obligations. But in the tight supply environment of 2025, with premiums on physical silver reaching extreme levels and availability constrained, even buying silver to cover short positions became problematic. This is what ultimately forced banks to seek that $17 billion in emergency funding from the Federal Reserve. They needed capital not just to meet margin requirements, but potentially to secure physical silver to meet delivery obligations that threatened to expose just how disconnected paper markets had become from physical reality. The silver crisis of 2025 represents far more than just a spectacular commodity rally or an isolated short squeeze affecting a few over-leveraged traders. It exposed fundamental vulnerabilities in the global financial system and derivatives markets and raised serious questions about leverage, market manipulation, and the role of central banks in bailing out institutions that take excessive risks. When the Federal Reserve provided $17 billion in emergency funding to prevent a silver market meltdown, it set a precedent that will be debated and analyzed for years to come. Should central banks intervene to protect institutions from losses incurred through speculative positions? Does such intervention create moral hazard, encouraging even more risk-taking in the future because traders believe they'll be bailed out if things go wrong? Beyond the philosophical questions, there are practical implications for anyone involved in financial markets or concerned about economic stability. The silver squeeze demonstrated that retail investors, when organized and informed through social media and online communities, can challenge and potentially defeat even the largest institutional players. This represents a democratization of market power that simply didn't exist in previous generations when information and coordination were dominated by large institutions. Whether this is ultimately positive or negative for market stability remains to be seen, but it's undeniably a force that institutions can no longer ignore or dismiss. For investors holding silver or considering positions in precious metals, the events of 2025 validated many of the long-held beliefs of the precious metals community, that physical shortage could eventually overwhelm paper manipulation, that industrial demand combined with investment demand could create explosive price action, and that patience and conviction could ultimately be rewarded even in markets that appeared rigged against retail participants. But the volatility and drama also served as a reminder that leverage is a double-edged sword that can destroy portfolios as quickly as it builds them, and that markets can remain irrational or manipulated longer than individual investors can remain solvent. As we close out 2025 and look toward 2026, the silver story is far from over. Prices remain at historically elevated levels, with some analysts predicting continued gains that could push silver toward $100 per ounce or even higher. The structural supply deficit shows no signs of resolving quickly, and industrial demand continues to grow as technological applications for silver expand. The financial institutions that were caught short are now reassessing their strategies, with some following JPMorgan's lead by flipping to long positions, while others may be planning their next moves in a market that has proven far more dangerous than they anticipated. The $17 billion Federal Reserve intervention that gave this documentary its title will be studied by economists and market historians as a pivotal moment when central banks revealed just how seriously they take derivatives, market stability, and how willing they are to intervene when systemic risks emerge. Whether this intervention prevented a broader financial crisis or merely delayed inevitable consequences remains to be seen. What's certain is that the silver market in 2025 taught the financial world lessons about leverage, manipulation, supply constraints, and the power of organized retail investors that won't soon be forgotten. The siege of the silver shorts may have reached a climactic moment, but the war for precious metals market integrity and stability continues, and the final chapters of this story have yet to be written.